In the world of investing, laying down a solid foundation is crucial, and Benjamin Graham's book, The Intelligent Investor, serves as a unique guide for those looking to do just that. Graham emphasizes that investing differs significantly from speculation. Success in investing doesn't require extraordinary intelligence or insider information, but rather a sound mental framework and emotional discipline. He categorizes investors into two main types: defensive and enterprising. A defensive investor opts for low-risk strategies, while an enterprising investor might take on higher risks with more analysis. These two approaches can yield different returns based on the investor's time and effort. For example, regularly investing in stocks can provide compounded returns over the long run. This highlights that even amidst Wall Street's fluctuations, those who act with patience and discipline can come out on top. Graham's advice encourages staying away from market hysteria and instead forming a sensible and consistent investment strategy, which is the key to achieving substantial long-term gains. In essence, Graham's methods offer a safe journey through the investment world. Understanding the difference between investment and speculation is incredibly important. Graham defines investments as operations that, upon thorough analysis, promise safety of principal and an adequate return. In contrast, operations that do not meet these criteria are speculative. In real life, many might think they are investing when they are actually speculating. For instance, those who buy and sell stocks without substantial market knowledge or engage in short selling may unknowingly be speculating. To prevent common mistakes in the investment world, Graham advises readers to develop the right mental and emotional behaviors. The key to success in investing is being prepared for market fluctuations and taking advantage of times when prices are attractive. Additionally, understanding the difference between price and value when making investment decisions is crucial. Just like when shopping in a store, knowing and evaluating the price is essential when buying stocks. This way, investors can make more informed and solid decisions against market fluctuations. Graham draws a fine line between speculation and gambling in the investment world. When speculating, investors often follow the market like a fun game, but it's important not to forget the risks involved. Graham suggests allocating only a small fund for speculative investments and never adding more money to it just because the market is rising. In real life, this can be likened to sports betting, where it's wise to wager only what you can afford to lose. For defensive investors, Graham recommends carefully balancing their portfolios between high-quality bonds and stocks. For instance, he suggests including bonds in the range of 25 to 75% of the portfolio, with the ideal balance being 50-50. This approach helps investors maintain a less risky position against market fluctuations. In summary, Graham's advice underscores the importance of being cautious and strategic when investing, which can be compared to carefully planning a budget in daily life to minimize risks. One of the most crucial strategies for investors is understanding market movements and choosing the right strategies. The challenges investors face in short-term and long-term selections are addressed. In the short term, it's tough to gain an advantage because market news is widely known. In the long term, accurately predicting the future is quite challenging. In reality, many investors follow market trends. However, Graham states that such strategies are not always successful. For example, predicting the future success of a new product in the tech sector is difficult. Therefore, investors should not rely solely on market rumors, but instead develop solid and unique strategies. Investors should adopt a contrarian approach against the general market trend and analyze the differences between market value and intrinsic value. Graham advises investors to make rational choices independent of market fluctuations. This strategy could be the key to achieving better than average returns in the long run. Accepting the difficulty of predicting the future when investing long-term is essential. Short-term experiences and emotional states influence investment decisions. For instance, the impact of inflation on stock prices and dividends is complex and not always as expected. During the period from 1966 to 1970, there was high inflation, yet stock prices and dividends fell, showing that inflation does not always boost company profits. At the same time, investors should diversify their portfolios to reduce risk. Instead of relying solely on stocks or bonds, adopting a balanced approach is more sensible. For instance, while bonds are generally seen as safer, stocks can provide better protection during inflationary periods. Assets like real estate or gold also have the potential to offer protection against inflation. However, these investments come with their own risks. Ultimately, being cautious in investment decisions and forming a diversified portfolio increases the chance of success in the long run. Investors should make strategic decisions considering market fluctuations and inflation. The ups and downs of the stock market offer both opportunities and risks to investors. Between 1949 and 1970, the Standard & Poor's Composite Index showed an average annual increase of 9%, but the pace slowed afterward. Particularly between 1968 and 1970, a 36% drop reminded investors of the need to be cautious amidst market fluctuations. The rapid recovery during this period reignited hope among investors, but also highlighted the difficulty of predicting future returns based on past market performance. Another significant point was the changing relationship between stock and bond yields. In 1948, stocks provided more returns than bonds, but by 1971, the situation reversed, making bonds more attractive. This shift requires investors to be more careful when diversifying their portfolios. In real life, such fluctuations can affect the future financial security of someone who has invested their retirement savings in stocks. Therefore, understanding market conditions and acting strategically is critical for financial success in the long run. Creating a safe and profitable strategy in the investment world is the goal of most investors. Some of the portfolio strategies Benjamin Graham suggests for defensive investors are highlighted. Graham recommends balancing portfolios between both stocks and bonds, explaining this with the 50-50 formula. This formula provides resilience against market fluctuations and helps investors minimize their risks. In real life, for instance, during a significant market downturn, this balancing approach can result in less damage for investors. Graham suggests reducing stock proportions when the market reaches peaks and increasing them when markets fall. Thus, investors are less affected by market fluctuations and can make strategic moves instead of emotional decisions. This approach, recommended for defensive investors, focuses on high-quality bonds and stocks, aiming to achieve stable returns in the long run. This method prepares investors for market conditions and allows them to make more rational and strategic moves instead of emotional decisions. Making the right choices in bond and stock investments significantly impacts an investor's financial success. In the investment world, bonds are generally seen as safer havens, but it's crucial to strike a careful balance between tax advantages and returns. For example, municipal bonds offer tax exemptions, while corporate bonds typically provide higher returns but are taxable. For investors in high tax brackets, tax-exempt bonds might be more appealing. However, while low-quality bonds' high yields may seem attractive, they can expose investors to unexpected risks. Instead of short-term bonds, deposit accounts offering high interest rates can also be considered. As in the 1970s, when economic conditions are volatile, investors should consider alternative routes. Stocks also offer protection against inflation and the potential for high returns in the long run. However, avoiding high prices in stock investments maximizes the buyer's benefit. For defensive investors, ensuring diversity in stock portfolios and investing in large, stable companies is important. This way, financial security can be ensured in the long run. Growth stocks are shares in companies that rapidly increase their profits and are expected to continue doing so in the future. These stocks typically outperform market profits. However, due to their high prices and speculative nature, they can be risky for defensive investors. For example, companies like IBM and Texas Instruments have historically provided significant gains, yet suffered serious losses during market downturns. Therefore, it is risky for the average investor to heavily weight their portfolio with such stocks. A more solid strategy for defensive investors is to invest in large companies that have fallen out of favor but have reasonable profit margins. Regularly reviewing the portfolio and seeking advice from experts is also important. Additionally, Strategies such as dollar cost averaging can provide safe returns to investors in the long run. In this method, stocks are purchased by investing the same amount of money each month, thus reducing the risk of buying at the wrong time. Ultimately, investors are advised to analyze their risk and return expectations well, shape their portfolios based on certain criteria, and seek professional help when necessary. Benjamin Graham emphasizes the importance of distinguishing between primary and secondary stocks in the investment world. Primary stocks typically belong to large and distinguished companies in the sector, and he suggests that these companies should have assets or sales valued at least $50 million. However, these criteria serve as guidelines rather than strict rules, and it's important for investors to use their judgment when making decisions. Graham offers several strategies for aggressive investors. First, investors should balance their funds between high-quality bonds and reasonably priced good-quality stocks. Second-quality bonds and preferred stocks, though they promise high returns, generally carry higher risks. Therefore, caution is advised when investing in such securities, especially if they are not purchased at low prices. Finally, while newly issued securities may appear attractive, buyers should be cautious. New issues are often offered under favorable market conditions, which can result in adverse consequences for buyers. Graham advises investors to conduct thorough evaluations before making such purchases. One crucial lesson from the investment world is the need to be wary of new stock issues, especially during bull markets. Often, during these times, investors act with the expectation of quick and large profits, losing their critical thinking abilities. The quality of newly issued companies can decline over time, and their stocks may become overvalued. For instance, Aetna Maintenance Company shares were issued at $9 in 1961, quickly rose to $15, then rapidly lost value, dropping to 7/8 of a dollar by 1964. Such examples show the need for investors to be cautious. Another strategy recommended for enterprising investors is to avoid focusing on growth stocks. These stocks typically have high price-to-earnings ratios and are subject to significant fluctuations. Even established companies like General Electric can experience such swings. Enterprising investors should consider that growth stocks are already expensive and that their prices harbor speculative elements. Therefore, it's important for investors to make strategic and careful analyses when making decisions. An important point highlighted in Graham's The Intelligent Investor is that the market often overvalues large and established companies' stocks. However, when these companies face temporary difficulties, their stocks may fall out of favor, creating a significant opportunity for investors. Large companies have the capacity to recover during tough times, making them a safer haven for investors. For example, General Motors in 1941 experienced a period when stock prices were low, but potential profits were high, creating an opportunity for bold investors. Another key point is buying bargain stocks. Graham emphasizes that when a stock is trading well below its intrinsic value, we should seize the opportunity. For instance, in 1957, many companies in the market were trading below their net working capital. Such stocks can provide substantial gains with proper evaluation and analysis. Lastly, he mentions that secondary companies can offer bargain paper opportunities. Secondary companies may not attract as much attention as major industry leaders, but when invested in at the right time, they can provide high returns due to their low prices. This requires investors to understand the market's whims and seize opportunities. Benjamin Graham notes that stock markets often deviate from reality, especially regarding the perceived value of secondary companies. However, this situation can provide various opportunities for investors. For example, small companies, particularly in the post-war period, were able to compete better than larger companies, increasing their sales and profit margins. This shows that there could be great potential for investors in small companies. Market fluctuations present both opportunities and risks to investors. Investors need to be prepared for these fluctuations. With a good portfolio selection, profits can be made from secondary stocks, even during periods of low valuation. For instance, a long-term holding strategy and purchasing at low prices can yield significant profits for the average investor. Special situations are another area of opportunity. Events such as large companies acquiring smaller ones can offer attractive opportunities to investors due to the market's misvaluations. However, such investments typically require more knowledge and experience. Graham emphasizes that these situations require careful analysis and that investors should develop their knowledge and judgment skills. The most important lessons from this book are: 1. The difference between investment and speculation. Understanding this distinction is crucial. Investments involve thorough analysis, safety of principal, and adequate returns, unlike speculation. 2. Emotional discipline and mental framework. Success in investing requires a sound mental framework and emotional discipline rather than extraordinary intelligence or insider information. 3. Defensive versus enterprising investors. Recognizing which type of investor you are can help tailor your strategies and manage risks effectively. 4. Market fluctuations. Being prepared for and taking advantage of market fluctuations can lead to success. This involves understanding price versus value and making strategic decisions. 5. Diversification and risk management. Diversifying your portfolio reduces risk and increases the chance of long-term success, taking into account inflation and market conditions. 6. Strategic analysis and decision-making. Rather than following market trends, developing unique strategies and making informed decisions is key to achieving better-than-average returns.